Welcome back. Well, let's focus on the primary markets now. IndiQube Spaces, their 700 crore rupee IPO opens for subscription. Through the IPO, the proceeds will be used to fund the capital expenditure of around 460 crores and also reduce debt by around 90 crores. To talk about its IPO offerings, we're joined by Rishi, the chairman, ED and CEO at IndiQube. Hi, Rishi. Good morning and welcome to the stock markets. Your IPO opens. So let's get the basic detail out of the way first. You're going to be raising close to around the fresh issues around 650 crores. Break up the expenditure for us, and part of it is going to be used to repay debt. So post the repayment, what will the debt number look like, or will you be debt free?
Yeah. So we are raising, as you rightly said, a fresh issue of 650 crores, and only 50 crores is the offer for sale. And we have only one institutional investor as of now, Westbridge Capital. They are not doing any OFS. They have been investors with us since 2018. And out of this fresh proceeds, 460 crores will go toward capital expenditure and expansion over the next 2 to 3 years. And we are planned 93 crores of repayment of debt. And our debt currently is 332 crores. And it is from a large nationalized bank and a private bank. It's a low-cost debt. Even then, we are retiring a part of that debt. And we are Crystal A plus rated. And the remaining 94 crores will be towards the general corporate purposes.
Okay. Mr. Das, I'm just taking a step back so that people have more clarity on your business model and the operating model itself. You currently have 115 centers. You have 6.3 million square feet of area under management. I'm guessing you don't own these spaces, right? I mean, just explain the model. And you're currently, the top line has been growing very, very well. We'll just put up the numbers. I mean, last 3 years, top line growth has really exploded from 500 crores, you're 1,000 crores plus. But the bottom line is still loss-making. Losses are reducing. Yeah. So just explain the model, and by when can we expect profits at the net level?
So if you, as you rightly highlighted, that we have a total area of 8.4 million square feet under management, with we having a leadership position in Bangalore, which is the largest managed office market in the whole of Asia Pacific and in general as well. And talking more specifically, as you rightly highlighted, the top line has grown in the last 3 years at a CAGR of about 35%. And we have a very, very healthy EBITDA margin. And one thing I would like to highlight that the accounting standard that we use currently is India's accounting standard. And that accounting standard does not factor in the rental as an expense. That's the reason you see that the EBITDA margins are very, very high. Now, the obvious question is, if EBITDA margins are so high, then suddenly how you have a profit before tax loss? That is on account of the India's accounting standard. For example, our total rental payout in FY25 was 502 crores, whereas as per the India's accounting standard, we have factored a depreciation and interest of 690 crores. So there is a 188 crore worth of additional expense that is there. And the company in FY23, when our accounting standard was IGAP, we have reported a profit before tax of 20 crores. And in FY24 and 25 also, company has been paying income tax. So that is one thing which investors need to watch out for, that due to the accounting standard, they are getting a different perception.
No, fair enough, sir. So get your point. The accounting is, making the bottom line a little lopsided, and we have to understand that. So let me look at the operating line itself. Your EBITDA is growing, but the margin keeps fluctuating. It was 40% in FY23. It fell to about 27, 28%. Last year, it rose to 58%. So at an operating margin level, what is a sustainable margin for your business?
So again, if you look at the EBITDA numbers that you are seeing, there is a fair amount of CCPS, which is the convertible preferential shares that have been issued. And there is again an accounting entry because of India's standards. So if you look at the cash EBIT, for example, that is a better impression of the business. And that has been fairly steady above 10% all the 3 years, if you look at 23, 24, 25. And it has been, the overall numbers are growing on that account, yeah.
Rishi, hi, morning. What will margins be what are sustainable margins in this business? Surely they're not 58%, right?
Yes.
What are sustainable margins?
So if I were to give you the cash EBIT equivalent, the margins have ranged between, I will say, 10 to 12, 13%. And that is a past indicator. And we have been a prudent player. If you look at our occupancy has been consistently.
Yeah. What is the sustainable top line growth that you see, Rishi?
So again, we can't comment on the future, but if you look at our area, today we have a total area, signed up area of AUM of 8.4 million square feet. We are paying rents today on 6.3 million square feet. So we have a pipeline of 2.1 million square feet, which will get added over the next 6 to 18 months. So that should basically all get occupied over a period of time. So we have a good headroom for growth. We have a lot of space that we have signed up as a pipeline.
Just like you gave that EBIT margin, cash EBIT margin number, if you can look at history and tell us what has growth been and is that sustainable?
Yeah, so basically, that has been very healthy. As you can see, like we have been between 10 and like you see 13% year before, you will see 12% kind of a number. So it ranges. And why this is slightly having fluctuation is on account of properties that we keep adding, because this is at an overall level. So as you can imagine, if multiple centers suddenly get added, there is a bit of a blip. But again, a good indicator for us is occupancy. And if you look at our overall occupancy has been 82, 83, now currently it is 86%. So if we run our business at good occupancy, I think all these numbers will follow. That
All
has
right,
been the trend in the last 3 years.
Rishi, very quickly, 332 crores is your net debt. It comes down by around 93 crores, is that correct?
Yes, yeah.
So you'll be left with around ballpark 240 crores in your books, which you're comfortable at, right?
Right.
God, that's out of the way. Value-added services, that's moved from sub 10%. It's moved to around 12.7% as of last fiscal year. Where is this number headed?
Sorry, we lost the voice.
Value-added services. Yeah. As a percentage of your mix, I think it was sub 10%. It's moved to around 12.7% odd. Yeah. Where is it headed?
Sorry, the last word I am not able to hear. Sorry.
Where is it headed, sir? Where is it headed? Value-added services.
Yeah. So value-added services, if you notice, has shown a growing trend. And why it is? Because the customers that come to us, they are buying more and more from us. That is one aspect. For example, if you look at our, like when employees take office spaces, they also buy services like food, typically transport and other services also. So that is where you are seeing an increasing trend over there. And like typically 3 years back, this number was about 9% of our overall revenue. And today it is all 12, 13%. So there is a very healthy uptake on that. And the same customers are buying in more. Another metric I will highlight is when customers come to us, they take space in one of the centers. And if they like us, they try and grow to other centers or they offer us more services. Today, if you look at 44% of our revenue is coming from clients who have taken more than one center from us. And this number was 20% 3 years back. So we are very fast, having a very, very high level of overlap in terms of spaces and services with the clients that we are serving.
Just a clarification, on the area which you're currently managing, I believe it's 6.3 million square feet, right? After utilizing the IPO proceeds, you are targeting to cross 8 million. Is that right?
Yeah, basically, if you see in our business, the capital expenditure has been about 1,500 rupees per square feet. So if we are raising 450 crores, that will suffice for 3.5 million. Plus, we have very good internal cash accruals. So that, and as of now, when I talk about 1st April 25, we have an inventory of 2.1 million square feet of space that we have signed up and yet to get operational.
So what is the total area you're currently managing?
Yes. So 6.3 million is which is operational, where we are paying rents and collecting rent from our tenants and all of that is happening on that 6.3 million. Whereas the total signed up space is 8.4 million. So this gives you idea about the pipeline, that 2.1, almost 33% of the space that is operational today is available as the pipeline.
Right.
Over the next
once you have this money, you will proceed with fit outs, etc. Right?
That's right. Yeah.
At that 1,500 rupees that you said per square feet.
Yeah.
We'll leave it there, but more numbers hopefully when we speak again during the listing. But good luck to you, and thanks for joining us. So lots of co-working sort of business models making it to the market. I think SmartWorks came to the market recently, and of course you have others which are already listed for a while, and I think there are a couple of more coming as well. We'll take a quick commercial break here. Devin Choksi on specific stocks on the other side. Stay tuned.